Justin, you're getting close. I see. How is your deal tracking?
Yeah, we're making progress. So completed the QOE actually just this week. So got a 80-page report from Depot, which is great. Started to review it last night. Got a term sheet from Alan, pretty quickly. I know that he's known for that. And kind of going back and forth with the seller, they've had a little bit of drop in revenue this year, but it could just be because they don't have really a good marketing program in place. But at this point, we're on track to close October 1. And as of now, the seller is going to carry over about $800,000 on a $2.8 million net purchase price. So things are tracking in the right direction, and hopefully we'll make it to the finish line.
Awesome. Good, good, good. Anybody else have anything they'd like to share about progress and direction? No? All right. Well, Rich, I don't know, any particular place you'd like to start with, either war stories or experiences on tripping points that tend to derail deals before they get to close?
Uh, yeah, thanks for putting the pressure on me, Doug. Came on there thinking I was just going to answer some questions. Um, no, I mean in general, we're seeing a lot of deals come through the pipeline, and a lot of it's still it's just normal stuff that really gets deals tripped up. Obviously, it's going to be valuation, the valuation gap between buyers and sellers. It's always the biggest point of contention. What you're seeing out there is, and it's the usual case. Sellers have a great year, and then brokers tell them, "Oh, we can get you, 4 times what you just earned on this one great year for your business," not realizing that buyers aren't, shouldn't necessarily take that one great year and think that that's transferable going forward. So there's always that disconnect, which tends to be the biggest, I guess, tripper of deals. And then beyond that, what we're starting to find out too is when you're starting to look at these deals, everything initially looks great. And then there's a couple of key questions that are, that you should definitely pose to the sellers, or the brokers when you first get started. That's the most important thing that I would think. Number one, you should really understand the business and industry so that, you're not just going off of what you're seeing in numbers, because the numbers may not make sense if you don't understand the context of what the business actually does. So I'd always start with understanding the business and the industry, and then going back to the numbers as more confirmatory from that standpoint, as far as understanding how the business is operating. And then the thing that I would really want, the question I would really pose to sellers or brokers initially right off the bat, there's 2 questions. Actually, there's 3. Number one, for brokers, how long has the business been on the market? Because you want to get a sense of, whether the seller is being unrealistic for a long period of time, if there's some major issue with the business that may not have been disclosed up front. You just kind of want to get a feel for how long it's been on the market. Number 2, the next question I would ask a broker seller is why the business is for sale. Because that, if you understand actually the seller's motivations, you may be able to structure a deal that makes more sense for the seller and for you. But then the third thing that I would always want to understand when you're looking at these businesses is you don't want to be buying a business where the seller is obviously the hub. So I would ask every single seller, what is it you really do on this business on a day-to-day basis? And if they say, I'm not hardly involved with the business, but yet, they're sitting at home in front of the TV making sales calls, or they're doing estimates. So, they're doing more than what they're actually saying. Yeah, I only spend 2 or 3 hours a week in the office. Yeah, that's because you're spending the other 30 hours at home working on the business. So try to make sure you understand exactly how key that person is to the business, because if you're buying buying a job is worth a lot less than buying a system that's already in place or a system that's scalable. And I think a lot of people end up getting tripped up once they get down the road. Hey, this business looks great. Then we start getting into the pre diligence, and then all of a sudden you figure out that this guy or this gal's working 80 hours a week, and it's like, okay, do I really want to deal with it? Or do I want to just keep my normal job? So that tends to be a big tripping point as well. So I mean, if you can kind of get comfortable with those, I think the rest of the process, it's never smooth, never smooth. I will never say that. But once you get through those three major items, at least that puts the deal in a context for you. So as you're looking at other items, you can kind of make a decision as to whether you want to move forward or not on a deal. But I tend to find that probably the valuation gap is the biggest thing, and there's ways to solve that gap with structure. But a lot of times there's just unrealistic, an unrealistic price that the broker is presented to the seller just to get the deal listed, and then you find out, oh, this thing's not, it's doing $1 million, but this guy's working, or this gal's working 100 hours a week to get to that $1 million, and all of a sudden that $1 million isn't really worth $1 million. You may be earning $4 an hour to get to $1 million instead of $100 an hour to get to it. So you just got to kind of keep that stuff in the context.
Yeah, and related to that, what I've seen, if there's any kind of patterns we can identify from the acquirer perspective, companies that tend to be a little more commercial than residential, the owners inevitably have a huge hand in the selling, the recruiting of business, the sales, lead gen, contract arrangements. They tend to be the bidders and estimators of the big jobs, and they tend to be the primary connection with suppliers. And those are three really critical elements of the success of that business that, if it's all concentrated in that seller, you'll have three giant holes in your organization if the seller does in fact go away. The estimating part, if anything, is probably the one area that's a little, I'll put air quotes around the word easier to fill, because you can find people that know how to do estimates and bidding on different trades and different activities. But if it's relationships with a concentrated customer base or relationships with really critical sellers, that's all relationship stuff. And you can't easily replace that without a really good transition plan of getting the seller to take you to those people and make the warm introduction and really help kind of grease and facilitate that transition. So those are some potential red flags to look out for. And I'm not saying the deals are not doable if all of that exists. I'm just saying those are big hills to climb, and you need to have a really good plan. And most importantly, a really good discussion with the seller about how to overcome that.
Yeah, and I agree. And a lot of that is, we get that stuff written into the transition services agreement, because usually you're going to want to keep them around for at least at a minimum 3 months full time. Sometimes it's longer, sometimes it's shorter, but you leave yourself with the option. But during that time frame, you want them transferring those relationships with you by introducing you to vendors and suppliers, customers. You really want to start building those relationships from day one once you get in, because once that person leaves, obviously you don't want the relationship with the customer or the vendor to die off. And both are important, because you could be getting some kind of discount or what have you from vendors because of that relationship. And obviously on the customer side, that's revenue generation. So I would, from day one, when you're not doing ACE stuff, I would definitely, try to make sure that you establish those relationships.
And again, I'll stress that that's a bigger risk in the predominantly commercial type businesses. The true residential, there's still a lot of that exists, particularly on the supplier side and maybe even on the estimating side. But perhaps not as much on the customer side because you're basically going retail. You're going to a wide audience of potential homeowners to get that out there. So I want to shift gears a little bit and reinforce a thought that probably is assumed and implied, but can occasionally get skipped. We had a situation recently where there was some difficulty getting year-to-date numbers. The deal had already been LOI had already been signed. We were partway into the QOE, but there was a real challenge getting year-to-date numbers. And here we are, July, almost August, and the 2024 numbers came in, and there had been hang on to your seats, a 98% drop in topside revenue. It was a virtual shutdown of the business for the first 7 months of the year.
Why was that?
And yet they're trying to sell it. Well, the story that's unfolding, and it's still some late breaking news we're trying to get our heads around. Story was it's a relatively small team. Justin, you asked the question, what kind of business was it? It's a sight and sound company. They do security camera installations and things of that sort. So on paper, it was a good blend between commercial and residential activities. So that was an appealing fix. The numbers pre-2024, I think it was about an $800,000 EBITDA, as I recall. So there was a rationalization of a purchase price of about 2.7, I think was the number. But here we roll into 2024 and discover a 98% drop in topside year-to-date revenue. And the answer we've been given is that one of the three key people, not the owner, but one of the most senior techs, had a serious family medical crisis that consumed all of his time. So he was off the board, has been off the board since January. But then you kind of go, okay, that's 1 out of 3, but what are the other two guys been doing? And in a very awkward way, it sounds like they just kind of said, we just decided to take the time off and regroup, and we weren't in the game. And it's like, wow, okay. So the first reaction was to totally walk away from the business. But we are having a discussion right now of, well, since the other numbers were there was a history and it was verifiable. Maybe there's something in there. The classic Ronald Reagan line, there's a pony in there somewhere. So maybe just seriously renegotiate either the price or the structure and make the owner agree to a pretty heavily discounted closing settlement, but with an opportunity to sort of earn it back over time if the numbers return to pre-2024 levels.
Yeah, that's one of those deals where I would be, if I saw something like that, number one, until I got that response from the seller, I would think, well, wait a minute, these guys they're selling their business, so all of a sudden they just think they're going to just sell it off and they're not going to do anything this year. They're just going to start counting the money and not doing anything, and they kind of let the business drop. Now, the explanation has been one tech wasn't around, which creates, in my mind, a reasonable high-risk scenario around that business, and that they're dependent on one guy. One guy equates to 98% of revenue drop. Okay, so then my next question would be, is that guy leaving the business? If he's one of the partners, he's probably leaving the business. So it creates a whole lot of risks around the deal from that standpoint. My way to solve for something like this, and this is just my personal way, and I'm sure Doug and the rest of the team, they have their way of doing this, but if this business has had a great history like that, and it looks like it's a solid business, I would actually structure this deal. I'd basically tell them, look, I understand there was a one-time event. This guy had a huge problem, a family issue or what have you, and the revenue drop. But That's a huge risk from my perspective. So let's do at least start off this business with a 100% seller finance installment deal. And it would be, we'll pay you a small portion up front, just to get into the business. You're going to finance this business over the next 5 to 10 years. However, as Doug said, and Doug basically alluded to this, if the business comes back, you guys are going to stay working in the business if the business comes back. And we see that. We have time to put systems in place to mitigate the one-person risk from a situation like that. Then ultimately what we'll end up doing is we will basically end up paying you for the business, and maybe you restructure the note at that point in time to 10 or 20%, and then the rest you can finance through an SBA loan or what have you to pay them off. But you really ought to see performance for that next year to 18 months before you commit to paying a full price. That way you kind of reduce your your risk going into the business, and at the same time you get to keep those partners in the business because it was their choice to let the business fall off. So if they really want to sell it at this juncture, this is a way that they can do it. They try to go out to the market with it like this. Any other buyer, smart buyer, is going to say, give me your year-to-date numbers. Let's see where you are. And, they may not get the same opportunity but if you've kind of developed a little bit of a relationship with them at this point, they've explained it to you and you can explain to them why you're doing it the way you're doing it, you still may be able to get the business for, a good price that benefits both you and the seller long term, but it keeps them in the business to basically make up for that period of time that they weren't working. They now have to work in the business to make that up, to show you that it's still a viable business. And in that meantime, you've got a chance to kind of bring some people in and, to kind of transfer those relationships, transfer the operational risk of the business and move forward from there.
Yeah, and the other thing to stress is that I know in a lot of our training and module and spirit of everything we share, we kind of steer you guys directly to SBA financing. Well, a circumstance like this is not bankable with the SBA. I mean, when the lender finds out that the 2024 is falling off the cliff like that, they're going to disapprove any request you've got. So to Rich's point, if there is a deal to be made, it could be totally privately financed with some notion of cash by the buyer and everything else in some kind of payout over time to the seller. So there's some opportunity like that. Troy, I see you've got a hand up. What's your question?
Yeah, I've actually ran into 2 deals like this recently. One was like a behemoth, like $2.5 million EBITDA. They wanted like 10 asking, and then I got their year-to-date financials, and it kind of looks like they're probably like trending down to like maybe like 1.5 on the year, and it's not due to revenue. It's mostly due to like a margin compression. But in scenarios like that, like I guess I'm just trying to figure out like how long do I spend on it? Because like they want 10 million. There's no way I'd even get close to that. We'd probably be looking in like the 5 to 6 range, pending that you could get comfortable with the you get comfortable with the margin compression and that it's not continuing to go down. But I guess I'd just like to get your perspective on like, when you see something like that where it's not 98%, but it's 40-50%, but sellers the expectations are like pretty disconnected. Like, do you just kind of move on, or?
Well, first thing I would do is try to figure out why the margin compression. Like, what's going on in the business? Is that a structural change in the business, or is it just something that's temporary? So you got to really understand the context of why it's declining, not just that it's declining. Because it could be a solvable situation from that standpoint. The other issue from that standpoint is that valuation gap. Is your $5 to $6 million price that you're willing to pay based on $2.5 million of adjusted EBITDA or SD, whatever you want to call it, or is that based on the $1.5 million number? Because if their expectation is that they're trying to sell the business based on $2.5 million, and you're valuing the business based on $1.5 million, then there's a couple of issues there. I would look at, because $2.5 million, $10 million purchase price, probably depend what industry is it in?
It's security.
I mean, it's probably a reasonable ask if that's a carry forward number. So what I would say is, if you're going to address that situation, number one, understand the reasons why. Or number two, there's a solvable structure in place. Maybe you offer them, if they're saying it's, they want 10 million, you're saying, and that's why I asked you the question: is your valuation based on the 2.5 million or the 1.5 million? Because if it's based on the $2.5 million gap, that's tougher to solve, because now you're just saying the $2.5 million is worth a lot less to you than what they're saying the $2.5 million is worth to them. Versus if it's $1.5 million and you figured out that that's more performance related and that you can get it back up to $2.5 million, then maybe the valuation, your perception of what the value is versus their perception, is a lot closer. You know what I'm saying? It might be a little confusing as to what I'm saying, but
Yeah, no, I know what you're saying. Yeah, mine would be based off of the 1.5. So, I mean, it's not that far down the conversation. I was just like wondering if it's even worth continuing, because it's like, at least relatively new on the broker market. Maybe they've been sniffing around. So like, I'm not sure if they'd be willing to like revisit those expectations like this early, or
what I say is you could structure a deal where maybe you put in like a forgivable note structure, which is more like almost like performance based or like an earn-out, so that if you see that this business can get back to 2.5 million, then maybe you pay them the 10 million. But if it doesn't get back to the 10 million or whatever, you end up buying the business for 6 or 7 or 8 or whatever that pro rata amount is that they close the gap on from that standpoint. So there's a solvable way of doing it. You just need to understand kind of context of what the $1.5 million or why the compression, and then understand if the sellers are really flexible on the term of the deal. Because like I always say, when I'm talking to sellers, even about deals I'm looking at, like, I always, and most of you guys have been around, have heard me say this, I'll pay you anything you want, but under the terms that I'm going to pay it. So if you want $20 million for this business, I'll pay you $20 million of it, but this is how it's going to be structured. If you want this amount of money, I can pay you this amount of money up front based on what my initial valuation calculation is. But if you want it, I'll give it to you. But here's the structure of how that's going to happen if I really like the business. And ultimately, that's how I ended up buying my business. It was more of a structure play. The sellers, they were kind of, I thought, weren't unrealistic, but we structured a deal that made sense for both, and sellers ultimately ended up getting pretty close to what they wanted. Not all of it, but they ended up getting pretty close to what they wanted in the end. But I didn't put down a whole lot up front as well. So
yeah, I'll echo what Rich started saying. When the margin decline is the issue, particularly if it's a year over year margin decline that's really substantial. I mean, I think I did the math in my head. That's like a 40% EBITDA change, something like that, and they're blaming it on margin compression. When I hear any change in margins, a couple of things that come to mind: if all of the prior 2-3 years look really healthy and they're tracking fairly consistently, and all of a sudden you have this big kind of blowout, that tells me either internally they've taken their eye off the ball, they aren't doing cash management properly, they aren't doing inventory properly. They're if it's a trade company like a plumber or an electrician, they're running to Home Depot to buy their parts and materials. They're not ordering in advance through credible suppliers where they can arrange discounts and things such as that. And that's just a management issue. That's breaking down operationally to impact your margin in that way. Now, over the last 3 years and, post-COVID, everybody has talked about supply chain interruption and supply chain problems, which have no doubt impacted margins when it comes to materials and supplies. But again, are those just temporary or are they really permanent? Has there been just some kind of seismic shift in the product they're offering, and the supplier of that product has just jacked their prices out the roof and are unwilling to yield on anything like that? There's a lot of those kind of strategic decisions that have to be understood on why that's changing. And the big question is it truly just temporary, or is it foreboding for the future and kind of the permanent environment the company's going to be operating in? So really,
Yeah, that I appreciate that. I think that so I think most of the employee base is unionized, and just from some like brief Googling, it looked like there were some issues with the with the union, and maybe and it used to be on the cost of goods sold. So the it looks like it's on like the cost of goods sold line.
yeah.
So
Okay. Mark, you had a question, sir?
Yeah, I wonder if there's a similar calculus on a corollary. So, what about a business that seems to be under out of control growth? Looking at one that's had tax returns of right around 2 million 3 years ago, and is approaching 4.5. And the same going on, with the SDE. Sounds like the land of milk and honey, but I wonder if there's any issues or concerns with uncontrolled growth. Not, and this is a manufacturing-based business, so capex, innovation, staffing, capacity. Do you have the same type of dashboard, portfolio of concerns over high growth as you do over contraction?
So high growth, you typically don't see that unless it's a startup or it's in a very, what I would say, a shift into basically a new market, new industry for a company. You typically don't, the typical companies that most of the AEs are dealing with, you're not going to see that usually in a plumbing company or HVAC or anything like that. It's just going to be reserved for that, something that's something on the edge, like the innovation's edge, or so to speak. The biggest thing with those types of companies are and I'm going to start from the financing perspective before I talk about the business issues. It's hard for a lender to really grasp, and Doug can speak to this more than I can because he was a former banker, but from a lending standpoint, but it's hard for a bank to lend against something like that because the growth just requires more and more capital. So it's like, lenders typically want to make a loan and know that, hey, you're going to pay this loan back plus the interest or what have you. But high growth tends to be very volatile. So, you could be growing 1 minute and then all of a sudden a new innovation comes in, all of a sudden you crash and burn. So lenders take a real cautious approach to that. So from a planning perspective, it's hard to get finance for something like that. I mean, you can get a financing. You can go to growth equity partners and growth equity investors to finance something like that. From a planning and operations perspective, it's tough because not only are you taking out, you have to consider when you're acquiring the business, and I'm going to say this from an acquisition standpoint, not only are you acquiring a high growth business, but you better be right on your assumptions moving forward. It's not about kind of what happened the last 3 years. Yes, you're going to pay for that growth or what have you, especially if it's a product or service that's a repeatable product or service that's being delivered. I mean, if it's something like, a business where they had one big job in the previous year, but it was not consistent with what happened in other years before that, prior to that, then that's a risk in itself, and that you might not get a big job again the next year. But if it's something that's just a product that they're manufacturing, it seems to be growing, it's a trend, or a service that's repeatable, they've got contracts in place that are just building upon that base, then you still have to be careful with your planning, because when you acquire this business, you're probably going to have to end up paying a lot more, especially in manufacturing. you're probably going to still have a lot of CapEx moving forward, especially if the business is scaling up. Now, they could have built a factory, let's just say, with excess capacity at this point, where you don't necessarily have to worry about that, but you'd have to obviously do your investigation through the due diligence process. But if they're just slowly building and adding as they're growing, then you know that there's going to be future CapEx that you need to plan for. And not only that, you're going to have to probably plan for headcount. You're going to have to probably plan for more management. Yeah, there's a whole lot of other issues that may be positive with a growth scenario. But I think when you're looking at something like that, from an acquisition standpoint, you have to be really, I would say, pinpoint in your next 3 to 5 year forecast, because that's going to require a lot more resources moving forward than a business that's just got it's on a, it's a service business. You know what they're doing. Yeah, you can grow it, but then you have to actively grow it. You have to go into a new market, or you have to add more techs, or you have to add, that sort of thing that you can actually control. So those are all my points around high growth. I'm sure Doug is a former lender, can kind of give you a little bit more insight on the financing side.
Yeah, I would agree. Rich pretty much nailed it. From a pure banker perspective, it's very hard, and your average banker almost is skeptical of a hockey stick growth curve. For a lot of reasons. Usually those, in the very rare occasion, is that sustainable, and whatever that growth, that earnings change over that shorter period of time may have been, you really do, you scratch your head going, is this just an anomaly? Is this just a crazy, strange opportunity that emerged, or what's going on? One of the rules of thumb that I learned from my bank CEO, and I've applied it many times since, if you can manage a business and achieve a 15% earnings growth in 5 years, you will double that business. Just take your pencils, take your calculators, do the math on that.
72 divided by 15.
If you can sustain that 15% earnings year over year, you will end up with a double value in your enterprise in just 5 years. So my point is, anything beyond that 15 is kind of, really? Seriously? Can you do? Because 15 is healthy, obviously. It's a very aggressive goal. It's a very big bogey, but it is one you can usually develop a really solid business plan around achieving. But anything beyond that it's either very rare air or very uncertain speculation. And that's the last thing a traditional bank's going to do, is speculate on your deal.
Yeah. I would say this, Mark, when you're looking at a business like that, the sellers are going to expect you to pay up for that growth. And it's going to be some sort of multiplier that you're going to be like, what? Even for a smaller company, they're going to be like, yeah, we want a 12x on this or whatever. And that's why I say it's probably that type of business is probably more, I would say it's probably better to get, if you really want to buy that, is to find a growth equity investor or growth equity fund that funds those types of opportunities, versus trying to layer debt on that. Because if you're going to layer debt on that and your next 5 year projections are severely off, and someone managed to lend you money on that, all of a sudden think about the nut that you're trying to cover with less revenues, less cash flow, just because you were off on a couple of different assumptions. So I mean, they can be financed and they can be bought, but it's going to be more of an equity type arrangement versus a debt from that standpoint.
Yeah, no, that's helpful. I think, again, what I'm hearing is that, the outer boundaries of both growth and contraction can both be problematic, which makes sense.
Yep.
Yeah. Stephen, you've had your hand up for a bit. What's your question?
Yeah, just to your earlier point about commercial businesses and the relationships that owners typically have, is that like always a red flag? Is there like what could potentially mitigate that? Is it just that somebody else on the team is handling the business development, or is it, like I know you mentioned transition plan, but what would make that more appealing, especially if the customers are really concentrated?
Yeah. Okay. So now that's two different issues. Okay. So one is the customer concentration issue. The other is the relationship issues. Now, if you combine both of them, then it's like huge. It's a huge issue. So on the relationship issue, it's not always. I mean, it's not a deal killer. You just have to find ways to mitigate that, or ways that you could theoretically mitigate it. And a lot of it is going to involve investigation to see how strong those relationships are and whether they are transferable or not. And then the second part of that would be, like, for instance, if you're doing like ACE or whatever, one of the recommendations I'm sure would be, hey, let's talk about developing a business development team that would effectively take over those relationships and then develop new business relationships. And you would not, it would not be based on that individual person's connections to certain markets, and that sort of thing. You build a system around it, a business development system, so that someone else can come in if that person left and basically handle those customers and then go out and get new customers. So it's not always a bad thing. And you see that a lot with the smaller businesses. I mean, that's just the nature of it, the commercially focused ones, as Doug said. Like I said, it's not a bad thing. There's just ways to mitigate it. Now, the customer concentration issue could or could not be a deal killer. And a lot of that really is going to be related to how solid, number one, what's the nature of the business and the nature of the relationship with that customer. So if Microsoft is, I don't know, you're buying a tech company and Microsoft is its sole buyer and they have a 10-year contract with Microsoft that's unbreakable. All right, that's a lot less risk than if Microsoft signs a 6-month contract and that's their sole client, because in that 10 years you have time to figure out exactly how to diversify your customer base from that standpoint. If it's a situation where it's a handshake agreement or a short-term agreement and you come in and all of a sudden now you're at loss of losing 100% of your business because it's one customer, that's probably a risk I'm not willing to take, at least with my money up front. I'd probably structure some deal where it's like, look, this is the deal, you're going to finance this thing for me 100% until I'm sure that this customer is actually returning, and then from there I'm looking for ways to diversify my customer base. If even the business can have a diversified customer base from that standpoint, because maybe there's something in the contract where it's exclusive to them and they can't do anything else outside of that. So, government. If government is a sole customer, but there's a lot of different levels of the government that are buying from this particular company, that's a lot less worrisome to me, versus like one municipality where it's just the garbage department and that's it, or something like that. But so, I mean, you have to really understand the context of what that one customer looks like, and the structure or the term of the contract and what have you, and then you can kind of figure out a mitigation strategy from that standpoint. But if it's one customer and one relationship, and that customer depends on that relationship, I'm probably liable to kind of walk away from that. I mean, it would have to be some unusual circumstance to, some unusual relationship that is rock solid to keep me in the deal. Doug, what do you think?
Well, I think when I start thinking about customer concentration, again, this generally shows up more so in the predominantly commercial oriented businesses than the residential. What you're up against operationally and from a scalability opportunity standpoint is if you've got, I'll say as many as 3 really key customers, and those 3 represent 60% of your revenue, what you're probably doing in that business, or what the seller is probably doing, he's custom tailored something to each of those 3. So they're not doing a standard, scalable, repeatable service delivery. They're doing a little bit custom here for number 1, a little bit for 2, and a little bit for 3, and then everybody else gets something else. That's not really a long-term scalable business model, because you're just custom oriented to serve those guys that are going to write you the big checks. in the early stages of a business, that's not uncommon to end up that way. You land your one whale account, you get really excited. Now you've added an extra zero in your top side revenue numbers and all the rest of your financials. But you'll find yourself really custom tailoring all your service ideas to that person, losing sight of the objective and the mission and vision you ought to be paying attention to. So that would be an element of that concentration that I would be worried about, is how much of that is very custom and very unique, because custom and unique also means, back to the margin issue, it's not a regular reliable margin generator, because those margins can go up and down depending on how you got to tweak that customized approach for that high ticket client.
And for commercial, like let's say HVAC, like what is an acceptable benchmark for customer concentration? Like what would you consider not concentrated?
That's a great
Or are they always
question.
concentrated?
No,
It depends on, think about it from this perspective. Are you talking commercial service or HVAC service, or are you talking commercial HVAC construction?
So they say they don't do new installation, they only do replacement, but then the true recurring revenue is like 5 to 15%. I don't know,
Yes.
like I don't know exactly what that means. Like, does that make sense? That is replacement counted as recurring in your opinion?
No, because
no.
replacement still, that unit still may last you for 10, 15 years or however long they last, and you might not do another unit for 10 or 15 years in terms of earning revenue. Now, recurring would be if you've got a maintenance contract on that unit, or a maintenance, or working on, some sort of a maintenance agreement to come out and look at the units or to examine the units, that they're paying some sort of subscription fee or yearly fee or monthly fee or what have you. That would be recurring from that standpoint. So I would say, if it's a business, if they've got like, I'll put it in this context, and then you'll have to kind of adapt to your situation. If it's a commercial HVAC service, okay, and I would say as long as they don't have customers, I would say probably the number is probably like, I don't know. If they don't have a situation where 10% or 10 customers are making up 30% of their business, it's probably diversified enough in terms of its cover, its base. But again, take it into context. You still have to, understand what the business is doing. I mean, if they're doing installations, if they're doing commercial construction, I could see in any particular year, if they're doing like replacements or installments or whatever, in any particular year, maybe they have a big job. There's a big, big project going up in the middle in downtown, and then they got this one-time revenue jump because they're doing a big install job there. So I'm not so worried about customer concentration on the construction side of the business, because you're going to have a mix of projects that come and go, a mix of customers that come and go. But on the service side, if you're depending on that service side where you're depending on those customers that reach out to you whenever there's a problem, or you have contracts or what have you, if you've got if there's, if you've got a group of customers that make up more than 50% of the business is really the number, really. And it's like somewhere around like 10. No, I'd say it's more like 5 to 7. Then that you've probably got a little bit of a customer concentration issue, but it's not that severe. Now, if you've got 1, 2, or 3 that are making up 50% of the business, that is a customer concentration issue. And I'm saying that on a more or less on the service side. But I mean, that customer concentration, what you consider customer concentration, is kind of malleable. It's not really a hard number, but you'll know it when you see it. It's kind of a hard thing to quantify, but I'd say usually, let's just say 3, 4, 5 that are making up 50% of the business. That's customer concentration versus probably 10 making up 60 or 70% of the business.
Yeah, and if it is that with, let's say 3 customers, 60%, like 1 customer, 30%, highly concentrated. It sounds like it's construction. They say it's replacement, but like the big customer, it carried forward over multiple years. Like all the revenue growth in the last between 22 and 23 is from one customer. Like, is that enough to say this is a red flag? And
It's not a red
deal?
flag, but you want to mitigate. I mean, it's something that calls you to look at it closely. I won't say it's like a red flag, which would cause the deal to stop. But I would say that's one thing you want to examine during the due diligence process is examine that relationship, examine everything that goes around that relationship, whether there's any contractual relationships, whether it's a person-to-person relationship, what's the history of working with that client been like, how long have they been a client, and then ultimately you might have to get it kind of factored into the terms of the purchase, where you structure, maybe even a seller note that's like dependent upon you maintaining that relationship with that particular customer, just to mitigate your risk around that. From that standpoint,
Yeah, I see.
Yeah, I would agree with Ridge. It's not really a red flag. It's more like a yellow light if we have to have a metaphor. It's like proceed with caution. Do an extra layer of due diligence to find out who those companies are, who they may be, because at that point you do need to understand the nature of the relationship and the probability that they're going to hang around with you if you can continue to deliver the goods the way the company did before. Typically in what I consider the core service categories, HVAC, plumbing, and electrical, when a company gets tied in with big general contractors and you're now a sub for that general, those are great relationships when you got the good ones, when you got the guys that win most of the deals and get to build most of the projects, and you can be on their short list of who they want to hire. Those are great relationships to have, good sustainable business usually, but then you're kind of hitching your wagon on their success and their ability to continue to move on. But like Stephen, I think you were at the workshop in Florida where Eric Williams was there. Did you remember him? Was that the contractor in Florida? Maybe it was a different workshop. Sorry, but
yeah, he was there.
I thought so. Anyway,
we've had 2 workshops in Florida, so I don't know if
I know. No, Eric was at the first one, not the second one. So anyway, Eric's company, it's second generation general contractor. They've been around like almost 50 years. To become a sub for them is a pretty big win, and be able to hang on and go to work on their projects, because number one, they're going to continue to be awarded projects. He keeps his pipeline really full, and so having him as a 40% of your revenue is not a bad deal. That's pretty reliable stuff.
And if like last question, but if there's like 500K of recurring contract revenue against like, and there's like, this is like a 1.3 million EBITDA business, and the broker is trying to say we want a 5x multiple because this is recurring, like, is that even worth continuing that conversation? Like, do they ever come down from that?
Well, first of all, they probably just need to be explained. I asked the broker, explain to me how this is recurring. Let them tell you exactly how it's recurring, because I think once they give the explanation and you point out that it's not recurring, they'll realize, that they don't understand the difference between recurring versus maybe possibly reoccurring revenue. So and they're different, because reoccurring revenue doesn't necessarily have to occur. Customer's not going to call you up and under obligation, whereas recurring revenue, if they're paying something over and over and over again because they're contractually based, or there's some sort of agreement or whatever in place, then that's recurring versus reoccurring, where they just buy something again because they can go somewhere else and buy that thing if they needed to, or they could not buy it. They would have discretion over not buying it. So that's really the difference. And so I'd actually ask the broker, tell me what you think recurring revenue. You don't have to say it like that because you might offend the broker, which I tend to do sometimes. But but just say, hey, can you tell me why you think this is recurring revenue, and get their definition, and then just nicely point out that it's not. So it's, you know, it's not warranted a higher multiple, since the
Okay.
buying decision has to be actively be made again.
Yeah.
Yep.
Okay. Thank you.
All right, we're kind of coming up on the hour here. Any other thoughts or questions anybody may have that we can help you with today? No? Okay. Well, I guess we're going to call this meeting adjourned, and thanks everyone for your participation. Good seeing everybody. As always, if anything comes up, feel free to reach out to Rich. No, I'm kidding. He, me
Yeah,
or
you can.
Rich. You can reach out to either one of us, but
Yep.
happy to help and good to see everybody. Have a great weekend. We'll see you next time.
Thank you both.
Gloria,
Bye-bye.
Gloria, I'll set our call up for next week. Initial call.
Okay, sounds good.
All right. Okay.
Thank you.
All right.
Okay. Bye.
Bye.